Aloha, welcome back to Accounting 201. We're starting chapter 13 on financial statement analysis. We're almost at the end of our textbook here. We have gone through the entire text. We covered the accounting cycle, first 3 or 4 chapters. And we got into more specific coverages of certain asset categories, inventories, cash, accounts receivable, long-term assets. We've also looked at liabilities, short-term as well as long-term liabilities. We have talked about corporation equity. It's kind of a complicated area. We covered that. And then we covered the statement of cash flows in the previous chapter. And so here we are at the end of the work week, so to speak. And we have completed our financial statements. And so the last step in the process is to analyze and evaluate our financial performance based on our financial information that we have put together. Financial statement analysis, in short. Some of the chapter highlights include introducing tools that the accountant can use to analyze and evaluate a company's financial statement. Some general categories of these analytical tools include what we call horizontal analysis. We look at data horizontally from period to period. Another type of tool that we can use is vertical analysis. In vertical analysis, we are looking at data vertically and primarily focusing on account relationships. Probably one of the more common relationships between accounts would be the relationship between the sales account and accounts receivable. Another one might be the relationship between the cost of sales account and our inventories. Some of the more commonly used tools in horizontal analysis, we do trend analysis quite often, and for vertical analysis, we use what is referred to as common size financial statements. We can also do a combination horizontal and vertical analysis, and oftentimes that can yield very useful analytical results for the accountant. And finally, a very commonly used type of tool in analyzing financial statements is what we call ratio analysis. I have a note here to refer to the text, page 617, for a list of commonly used ratios. And let's go quickly to that list. And if you are taking a look at it, you will see that ratios are generally categorized into 3 different groups. There are profitability ratios, which measure the performance of the entity. There are liquidity ratios, which measure the entity's ability to survive or keep on operating in the short term. Those are liquidity ratios. And solvency ratios measure the entity's ability to continue to operate or survive in the long term. And our text lists 15 different ratios in those three categories: profitability, liquidity, and solvency. That's a real quick lead-in to the chapter. And I think probably the best thing to do at this point is to simply work through one of the exercises in the textbook. And so what I've done here is kind of pre-prepped exercise 13-9 on page 639 of the text. I'm going to read the highlights of that exercise, computing the accounts receivable and inventory turnover ratios. Procter & Gamble is a multinational corporation, manufactures and markets many products that you use every day. In 2008, sales for the company were $83,503, and so I have that amount written in here. All amounts in millions, so we can just use the numbers given. The ratios come out to be the same amount whether we add the zeros for the millions or not. It says the annual report did not report the amount of credit sales, so we will assume that all sales were on credit. So that's a fair assumption. We assume that all sales are on credit, and that's an important point. Anytime we are working with account relationship like sales and accounts receivable, since accounts receivable is used only for credit sales, we want to make sure that the amount that we are using for sales reflects credit sales only and not cash sales. Okay? So we make that assumption. And finally, the average gross profit percentage was 51.3%. And so I have over on the right side penciled in 51.3%. And so we need to do a little bit of math here to fill in the blanks. We need to understand, first of all, that on the income statement, when we show percentages, every amount on the income statement shown as a percentage is always based on sales being 100%. So again, let me repeat that. Every percentage, when we show percentages on the income statement, sales is always 100%, and every other amount on the income statement is computed as a percentage of sales. So, using that basic premise, and also the fact that sales minus cost of sales equals gross profit, if sales is 100% and gross profit is 51.3%, we can get the percentage for cost of sales by simply subtracting these two numbers. And so when we do that, we come up with cost of sales of 48.7%. Put another way, if we have sales of $100, the cost of that sale, if we have sold one item for $100, and if our cost of sales percentage is 48.7%, that means that item that we sold for $100 cost us $48.70, and the gross profit on that item would be $51.30. That would be a simple way to convert the percentages to dollars, and hopefully it might help in understanding how those percentages work. Now, to get the dollar amounts for these two amounts, we would simply multiply sales times 48.7% to get the dollar amount of cost of sales. And that amount is $40,666. Again, sales times the cost of sales percentage gives us the cost of sales in dollars. And likewise, sales times the gross profit percentage would give us the gross profit in dollars. And that amount is $42,837. And of course, we could do a simple check of our math by simply adding down sales less cost of sales should equal gross profit. Now what we're doing is just developing some of the information to be used in the two ratios, actually the four ratios that we are being asked to calculate. We are being asked to calculate accounts receivable turnover and inventory turnover in requirement number 1. And then in requirement number 2, we are being asked to calculate the average days to collect accounts receivable and the average days to sell inventory. Now first we'll do the calculations, and then we'll spend a little bit of time talking about what they mean. So again, we have developed the basic income statement information up here for sales, cost of sales, and gross profit. And then below it, we have, from the exercise in the text, we have the beginning amount of accounts receivable and inventory. This would be at January 1 of the year. We have the ending amounts of accounts receivable and inventory. These two amounts would be at the end of the year, December 31. And so over on the third column, what we've done is gotten the average for each of those two account balances, because the average accounts receivable and the average inventory is what we use when we calculate accounts receivable turnover and inventory turnover. The way we get the average is quite simple. We simply add the beginning and ending and divide by 2. Again, we add the beginning and ending balances together and we divide that number by 2 to get the average for each of the two accounts that we're looking at, accounts receivable and inventory. Now, to calculate accounts receivable turnover, we divide our sales taken from the income statement. We divide our sales by our average accounts receivable balance. And the resulting number is 12.47. That means that we have sold or moved our average inventory for the year being $6,695. We have moved or sold that average 12.5 times during the year. For inventory, it's a similar type of calculation, but the numbers are different. We're using different numbers. Instead of using sales, we use our cost of sales amount. Now, this is something that for the average student can be a little bit difficult to understand. When we look at sales, we're looking at units sold times price. Units sold times price. When we look at cost of sales, we're looking at units sold times cost. What is the common denominator in each of these two calculations? It's the unit sold. So whether we are looking at sales or cost of sales, we're looking at the same number of units sold. The difference in each of these two totals is the difference between our selling price per unit and our cost per unit. So when we calculate accounts receivable turnover, since accounts receivable is increased by the amount of our sales, credit sales, every period, we need to compare our sales, which is at selling price, with our receivables, which is also at selling price. On the other hand, when we calculate our inventory turnover, we are still using our sales for the period, but our sales at cost instead of our sales at price. So our cost of sales gives us our total sales at cost. And we are comparing it, actually it's not a comparison, but it's a division calculation. We are dividing it by our inventory, our average inventory in this case, which is also stated at cost. And so when we get our inventory turnover, we take our total sales at cost and we divide it by our average inventory, which for the year was 7,640, and we find that we have turned or sold our average inventory 5.3 times for the year. You know, I'm thinking I may have used the wrong terminology when I explained our accounts receivable turnover. I may have said that this shows that we have turned or sold our average receivables 12.5 times. If I did, that was an error. What I should have said, and what is correct, is for accounts receivable turnover, this number 12.47 or 12.5 is showing us that we have collected. That's the key word there. We have collected our average accounts receivable balance 12.5 times for the year. And in the case of the inventory turnover, that calculation shows us that we have sold our average inventory 5.3 times during the year. Well, I hope that wasn't too confusing. If you're still confused on it, you can simply email me for further explanation. Now, the last part of this exercise asks us to calculate the average days to collect our accounts receivable and the average days to sell our inventory. And the way we do that, based on the formula that is provided in the textbook, and it's also given here in the exercise itself. It says divide 365 days, which is the number of days in a year, divide 365 by each ratio from requirement number 1. So if we were to divide 365 by 12.47 and 365 by 5.32, we would come up with the for the first one, for accounts receivable, we would come up with the average days to collect accounts receivable, which would be 29.26 days. Our average age of accounts receivable is not quite 30 days, 29.26 days. In other words, on average, from the date of sale, it takes us about 29 or 30 days to collect the sale. That's what that means. And for the second one, using inventory, the average days to sell inventory, if we divided 365 by our inventory turnover ratio, that would give us 68.57. And again, this is days. And what that is telling us is from the time we acquire an item of inventory, on average, it's taking us about 68 or 69 days to sell that item of inventory. So our ratios can be very useful, but I think this exercise might illustrate one point regarding ratios. For ratios to be even more valuable than simply calculating them like this for one period of time, a comparison, ratio comparison from period to period can make their usefulness, can highlight their usefulness considerably. In other words, in the first ratio, inventory turnover, we calculated a turnover of 12.47, or roughly 12.5 times. Well, is that good? Is that bad? The key is in answering that question. Is it higher than last year? Is it lower than last year? Another question that could be asked would be, is it higher than the competition? Is it lower than the competition? Is our trend in an upward movement, or is our trend in a downward movement? Are we improving, or are we, or is that ratio getting worse over time? And the same would apply for our inventory turnover. The same would apply for the number of days to collect accounts receivable. Is that number growing, or is it getting shorter? When it comes to collecting accounts receivable, the quicker we collect our receivables, the better. That means we're getting our cash sooner. And for the inventory ratio, 68 or 69 days to sell inventory, that actually seems a little long. I think the shorter the period of time from the time we acquire an inventory item to the time we sell it, the better. In other words, we want to move our inventory as quickly as possible. And so I think this exercise is a good one. It shows how financial ratios can be very useful, and they're a great tool. Should be done by every accountant who is working on putting financial statements together on a regular basis. I think you'll find this chapter kind of challenging, actually, and it's very useful information. Don't worry about memorizing formulas so much as being able to calculate these ratios by referring to the formulas provided in the text. But more importantly, I think it's more critical that you make a good effort to try and understand what these ratios are telling us about these financial statements. And with that, I'm going to end this lesson. It went a little long, but That will be it for chapter 13. And I want to thank you for your attention, and I believe this is the final lesson in the text. So thanks again for your attention, and hope you've enjoyed it up to now.